All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by Joseph Wang, aka Fed Guy, as you might know him on Twitter. Joseph, welcome to the show.
Thanks, Mike. Thrilled to be here.
All right, we've got a lot of really interesting information to cover here, and we're going to be diving into everyone's favorite topic, which is QT, also known as quantitative tightening. I don't think with something like QT, you can actually start at too high of a level. I'm sure folks will be very familiar with it at this point. It's kind of all the rage, kind of the biggest number one buzzword. But Joseph, can you just start from like a 10,000 foot view? When we talk about quantitative tightening, what are we talking about here? And since it technically began, I guess, 2 days ago, we're recording this on the 3rd, walk us through kind of the timeline of when this starts to take place as well.
Yeah, sure. So, QT was one of the biggest things I worked on when I was at the Fed. So I basically looked through it at all different kinds of angles. At a very high level, you can think of QT as a reverse QE. Now, what did QE do? QE at a high level took out Treasury securities and replaced them with liquidity. If you're a bank, that means reserves, which is cash held at the Fed. If you're not a bank, that means bank deposits. That means deposits held at a commercial bank. At a high level, QE reverses this, but not necessarily so. The thing about QT is there are a lot of different moving parts. Now, broadly speaking, I think of QT in two ways. One is that it adds duration into the market, which is to say it increases the supply of Treasury securities that the private sector has held. And the second part is that withdraws liquidity out of the financial system. And that part is actually less clear because there are different ways that QT can occur where it's less of a drain on the financial system. But I'll talk about the first part first. So what happens mechanically at QT? So the Fed bought a whole bunch of Treasury securities, right? Let's say the Fed bought a security and it matures. What happens during QT? Well, what happens during QT is that the US Treasury, it'll issue new debt and use the proceeds of that debt to repay the Fed. The Fed then takes that money and cancels it. It disappears out of thin air. So at the end of the day, someone somewhere in the world is holding a Treasury security that was used to refinance the Fed. So the total supply of Treasury securities in the market increases. Now, you can think of this as putting upward pressure on interest rates. At a high level, interest rates are really supply and demand. This is even more so between the 10 and, let's say, the longer dated Treasury securities, between 10 and 30 years. So, if you increase the supply of something, the price of something declines, and so that usually means, so for interest rates, for fixed income, that means higher yields. If you think about the purpose of QE, which was to push interest rates lower, it makes perfect sense that for QT, interest rates, all things equal, would be higher, right? So private sector has to absorb more. Now, it's the second part of QT that's a little bit less clear. So the way that liquidity is drained from the financial system, though, really depends upon who ends up buying those new securities. Now, there are ways that QT can go which will be absolutely painless, and I think that's what the Fed is praying for. So if you hear to what Fed officials talk about when they talk about QT, they're like, QT is going to be really painless. Why? Because there's tremendous amounts of money, about $2 trillion in the reverse repo facility. So the Fed thinks that when it does QT, money will come out of the reverse repo facility and simply, be used to purchase those new securities. And if that happens, it will be very painless. But there are other ways this can go as well. For example, let's say the people who buy these new issued Treasury securities fund them using deposits they hold at a commercial bank. For example, let's say I have $100 million in JPM. I buy a new Treasury security. I withdraw money from my bank account and I use it to buy the Treasury security. When you do QT in that fashion, what happens is that there's less money into the financial system. So on the one hand, you can think about, $100 million left the banking system, went to the Fed, and got canceled. So it drains liquidity in the financial system, which is good and bad. It's good if you want to stop inflation. It's bad, though, if you're in a context like we are today. So what's happening today? Bonds are being sold off. Stocks are selling off. Another way to look at it is everyone wants to hold cash. No one wants to hold bonds. No one wants to hold stocks. This is really different from other market regimes. Usually, let's say the stock market goes down and everyone wants to hold bonds. There's kind of a hedge there. So bonds are kind of a safe haven, but there is no safe haven now. The only safe haven is cash. and everyone wants to have cash, but at the same time, there's a possibility that with QT proceeding, there could be less cash in the system. At a high level, that means if you want cash, you're going to have to compete for a smaller pool of it. That means you have to lower what you're willing to accept for your assets that you sell. Maybe I have an Apple. Okay, well maybe I have like $100 stock. Instead of selling it at $100, maybe I have to sell it at $99 to get the cash that I want. If you step back, if you think about this, like in 2008, for example, or any other market crisis, what the authorities usually do is they add cash into the system. And the authorities, they understand market crashes are really all about people wanting to hold more cash. So they put cash in the system. That was what happened in 2008, and that makes things a little bit better. Now you're kind of doing the opposite. You're raising rates, you're telling everyone that we've got to tighten financial conditions, and you're closing the exits, so to speak. You're taking cash out of the system. So that's just one way the QT can proceed. It's always possible that things play out the way that the Fed officials think they will proceed, well, hope they will proceed, by money coming out of the reverse repo facility and funding QT. So beforehand, it's really hard to know actually how QT will proceed on the liquidity side, where it would drain the money. The easiest way for me, at least, to see what will happen is to just see what's been happening recently. The financial system, it's always changing and it's opaque. It's like markets, they're different regimes. If you just look at what happened recently, it's the Treasury raising money to top up its Treasury general account, which is its checking account at the Fed. So the Treasury issued a whole lot of debt and raised its TGA account balance by about $600 billion in the first quarter of this year. That's equivalent to QT from a functional perspective. Again, you're issuing debt, taking money out of the financial system. The difference being that when the Fed does it, it just cancels that money. But when the Treasury is building up the TGA, that money just sits idle in the TGA.
Joseph, can I actually pause you just for 2 seconds?
Yes. Always pause it, because I want to be able to address any questions you have.
We've gone through so much information here. I just want to make sure I understand everything right, and then I've got a couple follow-up questions for you about almost like what a soft versus hard landing on QT could look like. Because I agreed. I read your latest piece, and it seems like there's a good way this could happen, and maybe a less orderly way that this could translate into markets. So let me see if I can kind of repeat back to you what you just told me, right? Basically, the process of quantitative easing, right, is what we're unwinding here. We're doing the opposite, and we're going to be quantitative tightening. So what quantitative easing is basically an asset swap, right? And they're taking treasuries that exist out there that get issued by the US Treasury. They're moving it into the Fed in exchange for reserves, right, and kind of bank deposits, and that's this liquidity. And that has the effect of kind of pushing down interest rates, because what the Fed is actually doing is they're going out into the open market, they're buying, right, these fixed income securities, right? There's actually treasuries and there's mortgage-backed securities, which is what I want to get into as well. And that's increasing the price, which decreases the yield. Now that entire process is kind of working in reverse, right? So the Fed isn't actually going out and selling these fixed income securities, but they're going to let them expire. And basically, so that structural bid that's existed, right, for these fixed income securities is going away, which means the price goes down and the yield goes up. That's about right so far, right? So that's tightening financial conditions, right? That's why you're starting to see yields creep back up. That's why you're starting to see mortgage rates kind of creep back up in general. But basically, one of the other mechanics that you get into in your post, right, is what all this liquidity that they've created is doing. So right now, a lot of that liquidity is parked in the reverse repo facility because it's seeking higher yields than the artificially low yields that have been created by quantitative easing. I think what you're saying is what the Fed is hoping is that when quantitative tightening starts, when they're increasing the tightness of monetary conditions, financial conditions, those yields also start to become more attractive. So that $2 trillion that's sitting in the reverse repo facility could actually just find its way kind of into buying the treasury securities, and that would be like the best way that QT could happen. Is that right? So
you could think of money in the RRP as kind of just money that the system doesn't need. There's nowhere place to put it, like you mentioned. It's like excess, so it just sits there.
Got it.
So when you drain something that's excess, that's no one is deprived of liquidity, so it's very neutral. The way that would happen is if you have someone who steps up, like a hedge fund, borrowing from a money market fund to purchase treasuries. So the money in the RRP, it's held by a very specific type of investor. They're money market funds, and they're highly regulated. They can only invest in a very narrow set of assets, only the super safe assets. So they can go and they can buy treasury bills, which are short-dated treasuries, or more likely they will lend in the repo market. A repo is just a secured loan against treasury securities. When you lend in the repo market, you get treasuries as a collateral. So, it's super safe. That's why the money funds are allowed to invest in repo. Now, if the money funds were to withdraw money out of the reverse repo facility and then lend to a hedge fund who then takes that money to buy the newly issued treasuries, you'd have a beautiful, smooth, neutral quantitative tightening. But it all depends on the hedge funds coming in and having demand to borrow in the repo market. And that's just not happening. So I think some context is helpful to understand why. So the treasury market, like all markets, is dynamic and it's always changing. The marginal buyer of treasury securities to the tune of hundreds of billions pre-2020 was the hedge fund community. So they were buying treasuries and funding those purchases by borrowing in the repo market. So they were doing that as part of a trade where they would sell futures and hold the cash and try to basically harvest the inefficiencies between the futures market and the cash market. It's called a cash futures basis trade. That's a way for hedge funds to earn. It's basically collecting pennies in front of a steamroller. Because the amount you earn is very small, but you take a whole bunch of leverage. So fast forward to March 2020, everyone in that trade basically got blown up.
Yeah. Steamroller caught up, so to speak.
They totally got flattened. There are so many Bloomberg stories around then where you have these entire hedge funds who basically just got, broke basically. So usually what happens if you're in a trade and you get blown up is you don't come back for a while. If you think about the great financial crisis, a lot of that was centered in private label mortgage securities, and that industry has gone away and hasn't come back, even though we're like more than 10 years since. The cash futures basis trade will come back one day, but so far it doesn't look like it's back yet. So that's like basically the only way you could have a very calm QT if these hedge funds come back and they're willing to borrow, buy the newly issued treasuries by funding from money held in the RRP, but that's just not happening so far, at least.
So basically, to again maybe try to sum up what you're saying here, the most orderly form of QT is there's this almost excess amount of liquidity, cash that needs a home that could drain from the RRP, and that would be like the most orderly way that this could happen. Walk me through what a less orderly landing for quantitative ease or quantitative tightening could look like. Like where would that money kind of come from?
Yeah, so at a high level, you can think about, so what you think about as money really depends on who you are in the financial system. If you're a bank, it's deposits at the Fed. If you and me, it's deposits at a commercial bank, right? So what's in my checking account? Now, when you take money out of the RRP to fund QT, the total amount of bank deposits in the financial system doesn't change at all. So it doesn't really drain money, what most of us consider to be money. But a less orderly QT would be draining what we think of as money, bank deposits, and also what banks think of as money, which are bank reserves. So that happens if the newly issued treasuries that are meant to repay the Fed, that's not purchased by hedge funds using money from the RRP. That's purchased by people or investors using money held in a bank. What that does then is that it takes away money that was in the banking system, right? So someone somewhere, the total amount of money, M2, money supply, so to speak, declines when you do that. Now, usually that's not a big deal. I mean, the banking system creates money as it creates loans. What's interesting is that the pace of what this is proceeding. You have QT, which is going to proceed at an extremely rapid rate. So the Fed is saying a 95 billion maximum a month when it's in full steam. When it did QT last time, the maximum it ever went to was 50 billion. So that's a big difference. That's one thing. And the other thing is that you're going to have another drain that's happening at the same time as QT, and that's the RRP continues to grow, and it's going to grow even more. When the RRP grows, you're also taking money out of the banking system. So bigger context, we're in a place where everyone wants cash, but the supply of cash is declining. And that's from QT, and that's from the increase in the RRP. And I think these two have the potential to be disruptive to the markets because, well, I mean, listen, if you take away cash when everyone wants cash, then asset prices are going to have to go lower as people who really want cash are forced to sell at lower prices to compete for, a smaller pool of cash.
Right. I kind of think about this when the dollar rallies, right? That's bad for especially risk assets around the world, but basically everything. So like walk me through what happens when the kind of premium on cash goes up. And also, like, how would you almost measure this, right? We're getting into very esoteric kind of concepts here. Like, what is money? What is this type of money to this type of person? Like, where does this translate? Like, how does this kind of show up in the financial system? Like, where can we track this?
I'd just look at asset prices. I mean, if you have asset prices that are just declining and declining, what that tells you is that people don't want to hold assets; they want to hold cash. I think what's more interesting probably is the issuance side of Treasury. So you have this going on where you're draining cash out of the system, both from QT and both from the RRP, which could be quite significant. But you're also increasing the supply of treasuries. And I think that's probably going to be the biggest weak point for QT going forward. The way to think about this is to think about, well, what's the supply and what's the demand for treasury securities? And the supply looks to be, very heavy in longer dated treasuries. Now, the agency who decides what kind of treasuries to issue, that's the Office of Debt Management as part of the U.S. Treasury. Now, they have lots of levers to pull. They can decide to issue very short-dated treasuries, which are called treasury bills, and that's very neutral to the financial system. But instead, they've decided to actually reduce that issuance and issue more longer-dated treasuries. So going forward, what's going to happen is, partly because of the deficit, but partly because of QT, the non-Fed sector is going to have to absorb about $1.5 trillion in treasuries each year for the next few years. Historically, that's very high. So that's the supply side of the treasury market. Now, here's the demand side. Now, pre-2020, the marginal person that bought it was a hedge fund, as we talked about. Post-2020, the marginal buyer was Fed, of course, and of the commercial banks. And those guys are all out now. So you're walking into a situation that's actually very similar to the repo crisis in September 2019. Now, for those of you who are not familiar, in September of 2019, the repo rates basically exploded higher. Now, usually repo is a very sleepy market. At that time, repo was trading about 2.25%. Repo is sleepy, so maybe every day it'd go up maybe 2.26, maybe 2.20. It fluctuates around there. But in one day in September, it went to as high as 10%. So it literally just exploded higher and broke. And a lot of that has to do with the mechanics that were happening behind the scenes in quantitative tightening. So I guess I'll give a little bit of background about what was going on there. So heading into September 2019, there was tremendous demand in repo financing. Again, it's the hedge funds wanting to borrow in the treasury market, wanting to borrow in the repo market to buy treasuries. You have that going on, pushing repo rates higher and higher. At the time, the commercial banks, they were the marginal lenders of the repo market. Okay, so you have increasing demand, and you have a supply of cash in the market that's kind of shifting to the left. It's shifting to the left because of quantitative tightening, which is the Fed draining money out of the banking system. So when you have increasing demand and shrinking supply, eventually something breaks, and you have rates that go, to the moon, basically. And the same thing is playing out today, actually. So again, like I just mentioned, the U.S. Treasury is going to issue about $1.5 trillion, including QT stuff, that the non-bank sector, the non-Fed sector has to absorb, increasing demand for financing. At the same time, the people who are buying treasuries before walking away, in part because the Fed is taking away cash out of the banking system. Banks last time used their QE cash to invest in repo because repo rates were very high. higher than they could get by leaving the money on deposit at the Fed. This time, repo rates are very low, so it did not make sense for them to leave their money, invest in repo. So they instead invested in Treasury securities, which earned a higher rate than leaving money on deposit at the Fed. So the exact same dynamic, increasing demand for financing by the U.S. government, reducing supply of financing from the people who are investing in Treasury securities. You can easily have another accident happen, just like you did in 2019, where rates shoot up significantly. Now, another way to think about this is that markets who benefited from QE get hurt by QT. Last time around, markets that benefited from QE, repo market. This time around, markets that benefited from QE, Treasury market. And markets that get hurt from QT, likely the same. And that's kind of how I think about this. There's a lot of other aspects to this that suggest weakness to it, but I guess I'll stop here. If you have any follow-up questions and stuff.